All right, we are expecting to get a much clearer picture on the housing market this week as new and existing home sale data set to be released. It comes as mortgage rates hit a two-decade high at 7%, which has stalled the market, along with issues of inventory and high prices. Joining us now is Lawrence Yun, Chief Economist at the National Association of Realtors. Lawrence, thanks so much for joining us today. So I know last week when I saw that number of mortgage rates hitting 7%, it was a shocker to me. I was alive in the 80s, though not old enough to kind of know anything that was going on. But I want to ask you, are you expecting them to go even higher?
The 7% mark, last time it crossed that was back in November of last year, and that brought the home sales down in December and January. So clearly indicating the sensitivity of the housing sector to the mortgage rates. So right now the mortgage rates are touching that cyclical high level. I don't think it will break higher. I mean, I truly wish the Fed would stop raising interest rate because they are clearly overreacting. The overall inflation rate is calming down. So if the Fed basically say they're done, I think we could see mortgage rate trend down back towards 6%, which would be great news for all the potential home buyers, but also home sellers. Home sellers have been resisting to list their property, but with lower interest rate, maybe the cost of giving up their 3-4% mortgage rate becomes less painful.
You know, you're outlining a number of the dynamics that are making this market a bit of a head scratcher for some people, as we have people who do not want to relinquish their homes or sell their homes because they're enjoying those very low interest rates. But the fact remains, we have new home builders hitting record highs this year in terms of their stock. If you would have told me that at the beginning of the year, I would have said, no, that's not possible. But nevertheless, here we are. The housing market has proven quite resilient. Do you believe that there are just structural and structural factors that are just providing this incredible tailwind? And I'm just wondering what you see as maybe the cyclical and the variable factors right now.
Well, the long-term factors are about population growth and job growth. Mm-hmm. The job levels today are 4 million more people working compared to pre-COVID record highs. So we are continuing to add jobs, and naturally people have dreams about owning a home. So that is providing this steady interest in the home buying, while the cyclical factor is mortgage rate. That determines the timing of whether people can get into the market or whether they are pushed out of the market, depending upon their finances. We have seen the cash share transaction begin to rise because people who have substantial housing wealth, say in California, they're selling their property and going to nearby adjacent states of Idaho, Nevada, and purchasing all cash, just completely bypassing the mortgage market. So it is a very interesting market, and also very little distressed property sales, even though home sales are much lower.
Lawrence, I want to ask you, so we're going to go from Wall Street to Main Street here. You mentioned the word dream. A big part of the American dream is owning a home. Affordability has become a serious issue once again. Is the American dream dead?
Well, American dream is alive. Is whether or not Fed will permit that dream to be realized. Because if the mortgage rate was to somehow go up to 8%, now by historical standard, that is still not that bad, but by recent standards, that is very high, and it's going to price out many young adults out of the marketplace. So it's going to create a huge social divide. Homeowners smiling big, while the renters feel like their dream is out of reach, frustrated that other people are getting the housing wealth while they are left out, paying higher rents each month. So we don't want to create this persistent social divide. So one way to assure that there is a path towards ownership is to make sure that the economy is working correctly, and so far jobs are being created, even though now the numbers become a little less robust job creation. But the Fed, they have to look what the inflation will be in the future, and the future inflation, say by December, will be well under 2%, because the heavyweight component, the rents will be coming down for the simple fact that apartment construction is at a 40-year high.
All right, let's say mortgage rates do top out now at about 7%, maybe a little higher. Have you done the math? Do you know if they come down to 6% to 5%, what kind of value and what kind of deals that unlocks for the average home buyer here in the U.S.?
Well, if the mortgage rate was to come down, we always say that people on the fence, the buyers, are now in the fence and begin to search for homes. So we will have increased demand. But what will be unique in the current cycle is that as the mortgage rate decline, all these pent-up sellers are people who are currently living in a home, but they have additional child in the family. Maybe they got married, or maybe they have a new job at a different part of the town. They want to make those moves, but they don't want to make the move if the mortgage rate is very high, where they don't want to give up their current low mortgage rates. But if the mortgage rate begins to come down, some of the sellers will say, well, it is still painful, but not that painful, and they will make the move. So increase in demand and increase in supply as mortgage rate come down.
Well, we will certainly see what happens when we get some new data on this week on both sales and the next level for rates. And of course, we'll be watching to see where the Fed goes next. Lawrence Yun, Chief Economist at the National Association of Realtors. Thanks so much.
Thank you.